I'm Camille Minogue. This presentation on the use of grantor trusts to avoid estate and gift tax was prepared as part of an independent study under the supervision of Professor Craig Janes in the Taxation LLM program at the University of Washington School of Law. Judge Learned Hand famously said that taxpayers are entitled to arrange their affairs to minimize taxes. Grantor trusts are a prime example of how the tax code permits that in practice. Grantor trusts create a disconnect between income tax and transfer tax treatment that can be deliberately exploited in estate planning. This presentation looks at two of the most common ways this is done. Grantor retained annuity trusts, or GRATs, and intentionally defective grantor trusts, called IDGTs. I'll focus on how they work and how their risk profiles differ. So who would use GRATs and IDGTs? Those who wish to avoid estate and gift tax. To be in that league, your wealth has to be sufficient to trigger estate or gift taxes. This includes federal taxpayers with wealth in excess of the exemption amount of $15 million. It may also include state taxpayers in states with estate tax. For example, in Washington, residents with wealth exceeding $3 million may be subject to the Washington state estate tax. Both GRATs and IDGTs share some common goals. One is to freeze taxable values of assets at their current levels, to allow future appreciation on those assets to pass free of estate tax, and to reduce the size of the taxpayer's estate by the amount of the tax paid on the trust income. This figure illustrates a grantor's expectation for future appreciation on an asset over time. A GRAT or an IDGT can be used to cause the transfer of the appreciation to the grantor's beneficiaries without any gift or estate tax. How can this be done? By exploiting the features of grantor trusts. What attributes cause a trust to have grantor trust status? The grantor retains control or ownership powers over the trust assets. One must look at the tax code, particularly section 671 to 677, to see what level of control and ownership powers trigger the grantor trust status. If a trust has grantor status, then it has several useful properties for estate planning. The trust itself is disregarded for income tax purposes. That's section 671 of the tax code. Grantor's payment of tax on trust income is not a gift. That's according to Revenue Ruling 2004-64. And transfers between grantor and trust are disregarded for income tax purposes. Now, GRATs and IDGTs are engineered to qualify, just barely, as grantor trusts. They are intentionally drafted to include only needed powers that will also not cause estate inclusion. There are several powers listed in the tax code that give a trust grantor status. This list is not exhaustive. I will focus here on the first two in the list. Substitution power is the gold standard for IDGTs. It is supported by revenue rulings, and it is easy to draft with proper fiduciary constraints. A trust providing income benefit to the grantor is built into the GRAT structure and generally accepted as not causing estate inclusion beyond the retained annuity itself. GRATs and IDGTs are structured to leverage the grantor trust powers and properties to create opportunities for interest rate and basis arbitrage. Each technique effectively sets a hurdle rate, the 75-20 rate for GRATs, and the applicable federal rate for IDGTs, so that the appreciation in excess of that rate passes to the beneficiaries tax-free. Also, with substitution power, Grantor may be able to swap low basis assets for high basis assets, enhancing basis step-up opportunities. So let's jump in and begin with GRATs. A GRAT is an irrevocable trust and has a fixed term. Grantor must survive the term for the GRAT to succeed. Assets may only be contributed upon creation. At the same time, Grantor retains a qualified annuity interest, which will be paid out of the assets of the trust. The net value of the gift is the value of the contributed assets less the value of the annuity. The present value of the gift can effectively be zeroed out. How does that happen? By structuring the annuity to have the same value as the contributed assets. Here, the value of the contributed assets is the fair market value. Also, the value of the annuity equals the present value of the annuity payments using the 75/20 rate. Rather than zeroing out the annuity, some practitioners will set the difference at a small positive number, such as $100, and then file a gift tax return. The purpose of doing this would be to start the statute of limitations running. The IRS generally has 3 years to challenge the reported valuation and assess additional gift tax if it is found owing. Some important points about GRATs are as follows. It must be for a fixed term and require annuity payments to the grantor at least annually. Annuity payments may not be paid with debt instruments, like an IOU, and must be for a fixed amount. Additional contributions to the GRAT after its inception are not permitted. The GRAT should be authorized to make payments in kind to allow flexibility. It should also include the substitution power. Although it's not necessary, it does give a lot of flexibility. Let's see how a GRAT works with a rapidly appreciating asset funding the GRAT. On January 1st, 2023, Grantor contributed $1.2 million in Tesla stock to a newly created GRAT. That was comprised of 10,000 Tesla shares valued at $120 per share and having a basis of $100 per share. Annual annuity payments calculated to zero out the GRAT were $442,000 per year. The annuity payments were made at the end of 2023, 2024, and 2025. The trust instrument provided that the annuity payments could be made in kind, for example, with shares of stock, to avoid an untimely triggering of capital gains, solely to make the annuity payment. During the GRAT's 3-year term, the price of Tesla soared, going from $120 to $450 per share. At the end of the 3-year trust term, the remainder was $2.7 million worth of Tesla stock. Grantor first liquidated the remaining shares and distributed the $2.76 million in cash to the beneficiaries. Capital gains tax on the liquidation was $430,000, which was paid by Grantor. With the substitution power, Grantor has another option for how to handle the remainder. Instead of liquidating the remaining Tesla shares, Grantor may swap assets of equivalent value for the Tesla shares. Here, Grantor swaps cash for the remaining Tesla shares. Now the trust has cash to make the final distribution. Why would Grantor reacquire the shares of stock? If Grantor holds the stock until death, then there would be a stepped-up basis, so no capital gains tax at all. GRATs don't always succeed. Let's now turn to an example where the GRAT failed. This example again makes its point with real Tesla stock values, but 1 year earlier. On January 1st, 2022, Grantor contributed $3.5 million in Tesla stock to a newly created GRAT that was comprised of 10,000 Tesla shares valued at $350 per share and having a basis of $100 per share. Annuity payments calculated to zero out the GRAT were $1,204,000 per year. By the end of the year, when the first annuity payment was due, the value of the Tesla shares dropped to $120 per share. The GRAT assets at that point were worth only $1.2 million. The GRAT had to terminate due to insufficient assets to pay its annuity. Another cause of GRAT failure is the death of Grantor during the GRAT term. GRAT assets become part of the grantor's taxable estate due to the grantor's retained interest. Depending on how the GRAT is drafted, it can continue with the grantor's estate receiving the annuity payments and the remainder beneficiaries receiving the remainder at termination. How can the risk that the grantor will die during the GRAT term be mitigated? A series of short-term rolling GRATs can be used instead, typically 2-year rolling GRATs. The key benefit is, after a startup period, remainder beneficiaries will receive distributions on an annual basis with no transfer tax. Let's take a look at the process and how these rolling GRATs work. This is how it begins. The first GRAT is funded with a one-time contribution by grantor. At the end of year 1, GRAT A funds GRAT B with the first annuity payment. Grantor may supplement the annuity payment in creating GRAT B, but care must be taken to ensure any supplemental funds are contributed at the same time as the annuity payment. Regulations prohibit later contributions. At the end of year 2, the second annuity payment of GRAT A and the first annuity of GRAT payment of GRAT B combine to form new GRAT C. The remainder of GRAT A is then distributed to the remainder beneficiaries, and GRAT A terminates. Moving to the end of year 3, GRAT B's second annuity payment combines with GRAT C's first annuity payment to fund new GRAT D. The remainder of GRAT B is then distributed to the remainder beneficiaries, and GRAT B terminates. This leaves us with GRAT C and D. The process repeats for as long as grantor specifies or until a GRAT fails. If grantor dies during a rolling 2-year GRAT process, the active GRATs may terminate or continue according to their terms. To the extent that the GRATs continue, the annuity payments would be payable to the grantor's estate, with the remainder passing to the remainder beneficiaries at the end of the term. For estate tax purposes, the portion of each GRAT attributable to a grantor's retained annuity interest is included in grantor's gross estate under 2036, which in practice may approximate most or all of the GRAT depending on the timing of the death. Now we'll turn our attention to intentionally defective grantor trusts. Intentionally defective grantor trusts, like GRATs, shift future appreciation out of the taxable estate. They work best with rapidly appreciating assets. They utilize grantor trust income tax rules, and they're widely used in advanced estate planning. In contrast to GRATs, IDGTs are typically structured as a sale of assets to a grantor trust in exchange for a promissory note. Grantor trust status means no gain on the sale must be recognized. Without grantor status, it's just a sale to a separate taxpayer. Rather than a fixed annuity, the IDGT grantor receives promissory note payments. The note typically bears interest at the applicable federal rate. Because the trust is a grantor trust, the interest payments are disregarded for income tax purposes. A key structural difference of the IDGT is the seed gift typically cash or illiquid assets, equal to approximately 10% of the value of the assets sold to the trust. This initial capitalization supports the economic substance of the sale and the trust's ability to service the note. The seed gift uses a portion of the grantor's lifetime gift tax exemption. Other key differences are that the grant must have a fixed term and is highly sensitive to the grantor's mortality. Death during the term can cause inclusion in the estate. By contrast, an IDGT can be long-term or perpetual, and the sale is not undone by the grantor's death, making it structurally more flexible and often less mortality sensitive. Recall that you only need one grantor trust power to trigger grantor trust status. The substitution power is the favored one. Not only is it a powerful tool for engaging in basis arbitrage, but Revenue Rule 2008-22 provides clear, safe harbor conditions so that it will not cause estate inclusion. Other grantor trust powers may be used in an IDGT, but care must be taken of running afoul of the complex tax rules. With the stage now set, let's look at an example of an IDGT. Grantor sells a business interest valued at $1 million to a newly created IDGT on an installment basis in exchange for a promissory note. The note provides for interest-only payments for 10 years, with a balloon payment at the end of the term. The interest rate is based on the long-term applicable federal rate, here assumed to be 3.58%. The sale is accompanied by a seed gift of $100,000 to capitalize the trust. Over the 10-year term of the note, the grantor receives annual interest payments of $35,800, with generally no income tax consequences due to the grantor trust status. The full amount of principal is due at the maturity of the note. If the trust lacks sufficient liquidity to satisfy the balloon payment, it may distribute assets in kind, refinance the note, or rely on grantor substitution powers to exchange assets for cash to facilitate the repayment. Distribution to beneficiaries are governed by the trust agreement. For example, the IDGT may be structured as a pot trust, giving the trustee discretion to distribute income and principal among the beneficiaries as needed, rather than following a fixed distribution schedule. Now let's look at areas of potential IRS concern. The IRS may challenge whether an asset, for example, closely held business interests, have been undervalued, which would reduce the promissory note and result in a deemed gift. Discounts for lack of control and lack of marketability in the evaluation of those business interests are a frequent focus, especially where non-voting interests are involved. The IRS may argue that the sale is not a bona fide transaction if the trust lacks sufficient equity to support the purchase. A seed gift, often cited at approximately 10%, helps demonstrate economic substance and the trust's ability to service the note. The IRS examines whether the transaction has real economic substance, including proper documentation, adherence to payment terms, and actual enforcement of the note. Failure to respect formalities may support recharacterization as a gift. The promissory note must bear interest at or above the federal applicable rate. Below market terms or failure to make required payments may result in partial gift treatment. If the transaction lacks economic substance or is not properly implemented, the IRS may disregard the sale and include the transferred assets in the grantor's taxable estate under sections 2036 or 2038. In summary, GRATs and IDGTs are powerful estate planning tools that allow taxpayers to transfer future appreciation to beneficiaries while minimizing transfer tax exposure. GRATs are well suited for short-term appreciation opportunities, but carry mortality and market risk. IDGTs offer greater flexibility and eliminate mortality risk when properly structured, though they require careful attention to valuation and documentation. Choosing between a GRAT and an IDGT is ultimately a question of risk tolerance, time horizon, and execution. Both are fundamentally arbitrage strategies. They are designed to transfer appreciation in excess of an IRS prescribed rate. But their effectiveness depends on assumptions about valuation, performance, and compliance, and on how rigorously the transaction is actually respected in practice. When properly implemented, both techniques can play a central role in sophisticated estate planning. Thank you very much for your attention to this matter.